Hey, everybody, we're going to talk earnings today. It is earnings season for the first quarter of 2023, and we're starting to see some of the big banks report earnings. So we want to go through Wells Fargo's numbers today. Before we do, please click subscribe to my channel if you haven't done so already. And please check out the link you see on your screen from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So Wells Fargo was one of the first banks to report, and for the most part, the numbers look good. Wells Fargo beat expectations on both the top and bottom line, so it generated more revenue and had better bottom line profits than expected. And a big reason for that is net interest income. Interest rates have risen dramatically over the past year or so, especially when you compare the end of year 2021 to 2022 and the end of the first quarter of both years. So, since the first quarter of 2022, Wells Fargo's net interest margin, the difference between their expenses plus the cost of deposits and the amount they're charging on loans, has gone up from 2.16% to about 3.2%. That's a pretty big difference. And kind of similar to that, net interest income has grown by 45% year over year. Non interest income was kind of a weak spot with Wells Fargo. That was down 13% for a few different reasons. For example, Wells Fargo has essentially exited the mortgage business at this point, and it wasn't that long ago they were the number one mortgage originator in the market. So, for a few different reasons, non-interest income was down, but net interest income more than made up for it. The company has set aside an additional $1.2 billion for credit losses, which I think kind of scared investors a little bit. There are a lot of investor fears that customers are going to start having trouble paying back their loans, especially if a recession hits, unemployment spikes, or anything like that happens. We're seeing it kind of reflected in the numbers a little bit. Wells Fargo's charge-offs are definitely trending upward. It's not really to an alarming level yet. In fact, it's really just kind of regressing to pre-pandemic levels. So it's nothing to really concern ourselves with yet, but it's definitely something that needs to be watched. The company bought back shares aggressively during the first quarter. Wells Fargo is one of the smaller banks out of the big four. Um, and actually bought back more than twice as many shares of stock as JP Morgan Chase did in terms of dollar amount. So pretty aggressive buyback, spent $4 billion on buybacks during the quarter. Um, its deposit base continues to decline, which has been an industry trend, and it's not terribly surprising. Wells Fargo's deposit base is down 8% year over year. And if you have an account at one of these big banks like Wells Fargo, then you know that their savings accounts aren't exactly known for being the highest paying types of accounts you can get. There are a lot of higher yielding options, and that's really affected the big banks when it comes to deposit basis over the past year. We're starting to see that mitigate at some of the big banks, especially after Silicon Valley Bank failed a couple weeks ago. We started to see a lot of people move out of smaller, higher paying banks and into the safety of the big banks. But Wells Fargo, we're not seeing that quite as much. We saw their deposit base fell another 2% during the first quarter. So that could also be a reason that we saw the stock kind of come under pressure after earnings a little bit. But all in all, a pretty strong quarter. No big red flags, nothing to panic about. The bank's still very profitable. I like the aggressive buyback personally. I'm a shareholder of Wells Fargo, and I plan to keep it that way. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.